Hello, folks, and welcome to Kudlow. I'm Larry Kudlow. So many people, I suspect, agree with Biden Press Secretary Karine Jean-Pierre, who seems to expect that inflation has peaked and it's on its way down, and our troubles are virtually over. Please take a listen.
We expect the headline number, which includes gas and food, to be highly elevated, mainly because gas prices were so elevated in June. June CPI data is already out of date because energy prices have come down substantially this month and are expected to fall further.
Well, now, if you think that way, I beg to differ. While it's quite true oil and gasoline and food prices, for that matter, are the most visible price spikes, the fact remains that prices are rising across the board, not just food and energy. And this across-the-board price hike may well be getting worse, not easier. Now, we put up on the full screen a useful chart from my old friend and colleague, Robert Sinch. It shows that broad inflation measures called trimmed mean CPIs from the Cleveland Fed and the Dallas Fed are actually increasing, not decreasing. Now, these trim mean measures exclude the largest and the smallest price changes. In effect, they measure the middle 80% of price change movement. Take a look at that chart. You'll see they're actually broader than just food and energy. Now, you can see they've been rising steeply. That's the interesting part. Dallas going from less than 2% to 4%, and Cleveland shooting all the way up to 7%. Now, we also show in that chart the core CPI. The point is, let that be a warning that the current inflation cycle is broad and widespread and likely accelerating, regardless of 1 month's change or, some improvement in gasoline prices, which we welcome. But I don't know whether that's sustainable for the whole inflation problem. Now, also, many people are talking about the recent slump in commodity prices, which do filter into the wholesale price index, the PPI, and also signal inflation expectations and the real value of the dollar. Now, true enough, the dollar has gone up and commodities have slowed. But the commodity index slowdown is really more like a dip, not a major drop. Look at, over the past month or so, the CRB futures is down 12%. Year to year, it is still up 36%. By the way, if you went all the way back to mid or late 2020, that CRB futures index is up almost threefold. The Goldman Sachs index, very similar. It's off 11% over the past month or so, but it's up 44% year on year. These are broad indexes: precious metals, energy, industrials, agriculture, and so forth. So beware. Now, the M2 money supply has unequivocally fallen quite a bit, from roughly a 27% year-on-year gain, I think that was back in late 20, early 21, all the way down to only a 6% growth rate. I think the latest month is May. But monetary lags are long and variable, and the filtering through of the commodity dip and the M2 drop may not appear really fully until 2023 and even 2024. So caveat emptor, and I still see a lot of people in the soft landing camp, especially after Friday's 3,000 job jump in non-farm payrolls. Yes, it was a solid number, but household employment dropped 315,000, and households are off 2 of the past 3 months, and that's why participation rates have slipped. I don't want to be the killjoy, but I'm just saying the facts are a little less exuberant than some would have us believe. Real income has fallen 3.3% over the past year as big inflation has knocked down higher wages. And real retail sales have fallen 0.5% over the past year as higher wages are buying fewer goods. GDP did drop 1.6% officially in Q1. My personal view is we're on the front end of a recession. The Atlanta Fed, by the way, its GDP tracker is down 1.2% so far in Q2, but the quarter's not over yet. Now, another dashboard indicator, the New York Fed survey of consumer spending. And that shows that inflation expectations have become embedded in the economy. 1 year ahead, the inflation outlook is 6.8%. That's a new high. 3 years ahead, 3.6%. Even 5 years ahead, 2.8%. And remember, every one of those readings, along with the actual CPI and PPI, and the Dallas and Cleveland trim mean price indexes, every one of these is well above the Fed's 2% inflation target. So I'm going to argue this is going to be a long and difficult struggle to bring down inflation. There is no quick fix here. We don't know if gasoline prices will keep falling because there's a shortage. Ditto for oil prices. We just don't know. Now, finally, the Democrats are trying to put together a $1 trillion reconciliation bill that could spend $1 trillion, might well raise taxes more than $1 trillion. We don't know all the details. But we know they're cooking up Build Back Smaller. And we also know more spending will steepen inflation and higher taxes will deepen recession. The Joint Tax Committee just scored the Senate Democrats' tax hike, and it shows that basically everybody across the board will get hit with higher taxes, most especially the middle class. And there's higher taxes on small business pass-throughs, large corporations, foreign corporations, and the wealthy. All that's going to damage incentives on the supply side of the economy. It is exactly the wrong policy. No wonder a recent poll shows that 93% of working-age Americans say the economy is either poor or fair. That's the most agreement by the most Americans I've ever seen in my lifetime since Ronald Reagan was elected president in 1984. So I would say to my Democratic friends, why don't you listen to America? No tax, no spend, no regulate anymore. Stop. Instead, save America. Kill the bill.